Imagine someone offered you the chance to buy Apple, Amazon, or Microsoft at a 40% discount. Most people would see that as an incredible opportunity. Now imagine that discount happens tomorrow. Not because these companies suddenly became worse, but because the entire stock market crashes. Instead of getting excited, millions of investors panic. They rush to sell. But why? What causes a stock market crash? Where do trillions of dollars seem to disappear? And why do some investors build fortunes during the worst days in market history? By the end of this video, you'll understand how stock market crashes happen, where the money really goes, and why a crash isn't always as disastrous as it seems. Before we understand why stock market crashes happen, we first need to understand what a crash actually is. The stock market moves up and down every day. That's completely normal. A stock market crash is different. It's a sudden and sharp decline in stock prices across a large part of the market. This usually isn't caused by one company. It happens when fear spreads among investors. As more people sell, prices fall. Those falling prices create even more fear, which causes even more selling. Imagine someone shouting "Fire" inside a crowded theater. People rush toward the exits before they even know if there's real danger. The stock market often behaves the same way. When confidence disappears, a normal decline can quickly become a market crash. So what creates that fear in the first place? Most crashes don't happen overnight. They build over time. Think of stacking blocks. Everything looks stable, until one final push causes the entire tower to collapse. Stock markets work similarly. High inflation, rising interest rates, weak corporate earnings, financial crises, or unexpected events like the COVID-19 pandemic can all shake investor confidence. When investors expect companies to earn less money, they begin selling. Lower prices make other investors nervous. Soon, fear spreads across the market. What started as a normal correction turns into a full-blown crash. But here's the biggest mystery. When the market loses trillions of dollars, where does all that money actually go? This is one of the biggest misunderstandings about investing. Imagine your house was worth $500,000 last year. Today, buyers are only willing to pay $400,000. Did someone steal your $100,000? No. Its market value simply changed. Stocks work exactly the same way. A stock's price is based on what buyers are willing to pay. When investors become fearful, they offer lower prices. As prices fall, the market's total value falls too. That's why headlines say trillions of dollars were wiped out. In reality, most of that money wasn't cash sitting in bank accounts. It was a decline in market value. Of course, if someone sells during the crash, their loss becomes real. But investors who continue holding strong companies may recover if those businesses and the market recover over time. So if the money doesn't simply disappear, why do crashes still hurt millions of Americans? Stock market crashes don't only affect wealthy investors. Millions of Americans invest through 401ks, IRAs, pensions, and retirement accounts. When the market falls, the value of those investments often falls too. Businesses also feel the pressure. Some reduce hiring, others delay expansion. And during major downturns, layoffs become more common. As consumers spend less, businesses earn less, which slows the overall economy. That's why a stock market crash affects workers, families, small businesses, and the entire economy. Yet while many investors panic, others see opportunity. A market crash can be scary, but experienced investors often see it differently. Imagine your favorite store announces a huge sale. Most people would be excited. Yet when the stock market goes on sale, many people panic instead. They assume falling prices mean every company is failing. But that's not always true. Sometimes, great businesses become cheaper simply because fear has taken over the market. If a company still has strong earnings, good leadership, and long-term growth potential, its lower price may become an opportunity. Of course, not every company survives. Every investment carries risk, but history shows that patient investors who avoid emotional decisions have often been rewarded over time. So, what does history teach us? History is full of market crashes. The crash of 1929 helped trigger the Great Depression. Black Monday in 1987 saw the Dow Jones lose more than 22% in a single day. The dot-com crash burst the internet stock bubble. The 2008 financial crisis shook the global economy. And in 2020, the COVID-19 pandemic caused one of the fastest crashes ever recorded. Each crash felt like the end. Yet over time, the U.S. stock market recovered from every one of them. History doesn't guarantee the future, but it reminds us that markets have repeatedly recovered after periods of fear and uncertainty. No one knows when the next stock market crash will happen, but crashes are a normal part of investing. They create fear. They dominate the headlines, and they make it feel like everything is falling apart. Yet history teaches the same lesson again and again. The biggest losses often come from panic, not the crash itself. Successful investors stay informed, think long-term, and avoid emotional decisions. So the next time you hear that the market has lost trillions of dollars, don't just ask, "How much did the market fall?" Ask, "Has the value of great businesses really changed? Or is fear simply driving prices lower?" That one question can completely change the way you think about investing. If you enjoyed this video, don't forget to like, subscribe, and turn on notifications for more videos about investing, money, and the U.S. economy. Thanks for watching, and I'll see you in the next video.